Most people think you need to pick individual stocks to strike it rich in the market. The shocking reality is that over 90% of professional fund managers fail to beat a simple index fund over a 10-year period. You do not need to guess the next tech giant to build massive wealth right now. By focusing on exchange-traded funds and mutual funds, you automatically buy a basket of the highest performing assets on Earth. Today we are breaking down the absolute best funds based on hard financial statements, manager ratings, and explosive momentum metrics. The first powerhouse on our list is the Vanguard S&P 500 ETF, known by its ticker VOO. What most people don't know is that this single fund gives you instant ownership in America's 500 largest companies. Look at the hard numbers. This fund tracks an index boasting an average annual return of around 10% over the long term. Right now, its momentum chart pattern shows a clear bullish breakout, driven by massive corporate earnings. Tech giants like Microsoft and Apple dominate its top holdings, pumping out historic profitability metrics. With a microscopic expense ratio of just 0.03%, you keep virtually all your gains. Fund manager ratings for Vanguard are consistently gold standard because their replication error is practically zero. If you want a rock-solid foundation that benefits from institutional volume, this is your starting point. Building on that US exposure, we have to look at the explosive growth happening in tech, which brings us to our second fund, the Invesco QQQ Trust. This fund tracks the NASDAQ 100 index, making it a pure play on large-cap innovation. The specific example here is the staggering data on capital expenditure. Tech giants are projected to increase infrastructure spending by 75% this year alone. QQQ captures this momentum perfectly, with its price chart firmly hugging the upper Bollinger Bands, signaling massive institutional volume. The qualitative story here is simple. Artificial intelligence is moving from a hype cycle to actual balance sheet revenue. Before you skip to the end of the list, realize that QQQ carries a slightly higher expense ratio of 0.20%. However, its trailing 5-year growth metrics have completely crushed the broader market. It is an essential vehicle for intermediate investors looking to maximize their wealth velocity. Our third contender takes this innovation theme and narrows it down to the exact physical infrastructure driving the globe, the VanEck Semiconductor ETF, ticker SMGB. The surprising part comes next. While software companies are being repriced, the physical chip makers are experiencing historic volume. This specific fund has logged an incredible return of over 130% in a single year. It holds dominant manufacturing firms like TSMC and ASML, which possess an absolute monopoly on advanced chip production. Financial statements for these underlying holdings show gross profit margins exceeding 50%. Chart patterns reveal a powerful cup and handle formation, indicating that the institutional accumulation phase is far from over. This is not a slow index, it is a high beta momentum monster. For beginners, a smaller position size here offers a high-octane growth engine fueled by unavoidable global demand. To protect against sector concentration, our fourth selection shifts our focus globally with the Vanguard FTSE All-World ETF, ticker VWRP. If American tech faces a sudden correction, this fund acts as your ultimate financial shock absorber. It holds over 3,000 stocks across both developed and emerging economies. Real numbers show it has delivered a rock-solid 25% return over the past 12 months. Recent media coverage highlights how international markets are currently trading at a steep discount compared to US valuations. This means you are buying high-quality global earnings at a remarkably low price-to-earnings ratio. The volume on this asset is incredibly deep, meaning you can buy and sell instantly without moving the market price. It provides a massive baseline of safety while still capturing the global rising tide. Now we must look at a massive geographic shift that most investors are completely blind to, leading to our fifth fund, the Franklin FTSE Korea UCITS ETF. South Korea has become the single best-performing equity theme of the entire year, with related funds gaining an average of 86%. What is driving this insane price action is a major qualitative catalyst called the Corporate Value Up program. The Korean government is actively forcing companies to improve corporate governance and boost shareholder returns. On top of that, its major holdings like Samsung dominate the global memory chip supply chain. The financial statements show massive cash reserves that are now being unlocked through dividends and the buybacks. This creates a highly favorable asymmetric risk-to-reward profile on the daily charts. If you are finding this breakdown valuable, hit the subscribe button right now to stay updated with actionable market insights. The sixth vehicle on our list addresses a critical constraint of this global tech expansion, the State Street SPDR MSCI Europe Energy ETF. All those new artificial intelligence data centers require an astronomical amount of electrical power. This fund captures traditional and transitioning energy giants that are printing record-breaking free cash flow. The numbers are hard to ignore, with the sector delivering an average return of over 29% recently. Profitability metrics are soaring because energy prices remain structurally elevated due to geopolitical tensions. When you look at the chart, you see a beautiful, steady staircase pattern of higher highs and higher lows. It serves as a fantastic value-focused hedge against your high-growth technology assets. Our seventh spot introduces high-performing active management through the Capital Group Core International Equity ETF, ticker CGIC. While passive index funds are great, brilliant fund managers can exploit specific market inefficiencies. Morningstar awards this fund its highest gold rating due to an incredible management team. They specifically screen for international companies with robust profitability, growing dividends, and bulletproof balance sheets. This qualitative vetting process allows them to completely bypass struggling companies that drag down normal index funds. News and media sentiment around this fund are highly positive as institutions rotate cash into defensive, high-yielding international equities. It gives intermediate investors an edge by combining structural safety with active alpha generation. This brings us to our eighth selection, which shifts away from equities to focus on smart capital preservation, the Amundi Smart Overnight Return ETF. What most people don't realize is that keeping your extra cash in a standard bank account is actively losing you wealth to inflation. This money market fund tracks short-term overnight interest rates, letting you earn a safe yield on your dry powder. Volume on this asset has surged to historic levels as investors look for a secure place to park cash during periods of high market volatility. The price chart is a literal straight line moving upward with zero drawdowns. Actionable insight here is simple. Use this fund as a high-yield holding tank for your investment cash while waiting for stock market pullbacks. For our ninth fund, we look at an incredible growth trend that is officially taking off, the VanEck Space Innovators ETF, ticker JEDI. The commercial space economy is no longer science fiction. It is a booming reality with massive military and communications contracts. This fund recorded an astonishing return of over 360% in a single month alone. Its holdings include satellite operators and rocket manufacturers with explosive revenue growth metrics. The chart pattern shows a classic momentum breakout on heavy institutional volume. While this fund carries a higher expense ratio of 0.55%, the qualitative growth potential is virtually limitless. It is the ultimate forward-looking asset for a truly diversified modern portfolio. Finally, our 10th fund is the iShares Core MSCI World ETF, ticker SWDA. This is the ultimate set-it-and-forget-it vehicle for absolute beginners. It tracks over 1,500 companies across 23 developed nations, delivering a stellar 24% return over the past year. Its financial backing is massive, ensuring deep liquidity and tight bid-ask spreads. The chart pattern shows remarkably low volatility compared to sector-specific funds. It gives you the steady, reliable growth of the developed world with a rock-bottom holding cost. To see exactly how to allocate your capital across these 10 powerhouses, tap the video on your screen right now. Make sure to tune in tomorrow to see how the market reacts to the critical economic data dropping today.